Hello. In this presentation, I'm going to look at exchange rate risk, both in terms of what it is and how it can be managed. As was discussed in the Sources of Finance presentation, there is a direct link between the return required by investors and the risks that they face. Accordingly, it is essential that businesses both identify and attempt to manage risk, of which exchange rates is one example, in order to keep the cost of finance as low as possible. Specifically, this presentation will cover exchange rate mechanics and terminology, types of exchange rate risk, managing translation risk, managing economic risk, and managing transaction risk. Let's look at each of these in turn. Exchange rate mechanics and terminology. An exchange rate is effectively the cost of buying one currency with another. For example, a rate of $2 to the pound indicates that if you have £1, you can use it to buy $2, notwithstanding any transaction costs. You have exchanged your pounds for dollars. The same relationship could be expressed as £0.5 to $1, and either way, the rate at which the currency could be exchanged now is referred to as the spot rate or spot. An added complication, however, is that banks or similar institutions offer different rates depending on whether you are buying or selling a currency. Accordingly, rather than seeing the rate expressed as $2 as above, you may see it quoted as $1.97 to $2.03. The difference between the numbers is called the spread, and this is part of the profit that the bank makes on the arrangement. If you think of a bank as a trading organization, they will buy at a low price and sell at a high price. Unfortunately, this means that businesses will buy at a high price and sell at a low price, the exact opposite of what they would like to do. Let's look at an example. Imagine you are a UK business that has $1 million that it wishes to exchange for pounds, and the spot rate it has been quoted is $1.97 to $2.03 to the pound. Firstly, you should always consider the exchange from the perspective of your domestic currency. So, in this case, as a UK company, we need to think in terms of pounds. We are going to use the dollars to buy pounds. We will buy at a high price, the opposite of what we would like to do, and we will receive £492,610.84, being $1 million divided by 2.03, the higher of the two rates. Finally, if the spot rate of $2 moves to $1.90, buying dollars has become more expensive for a UK company. £1 will now only buy $1.90 compared to $2 previously, and the dollar is said to have strengthened against the pound. Saying the pound has weakened against the dollar would be exactly the same thing. Types of exchange rate risk. There are broadly three types of exchange risk. In mathematical terms, risk simply means a variability in the possible outcomes, and the wider the range of possible outcomes, the higher the risk is said to be. In this regard, therefore, a currency moving in favour of the organisation would be a risk in the same way that a move against would be. Notwithstanding this fact, the word risk is used in everyday language in a negative way. We only talk about the risk of something bad happening. And even in business, we tend to worry more about the downside. Management of the risk will be covered later in the presentation. However, the risks themselves are explained below. Translation risk is the risk that the value of an overseas asset will change when the asset is translated into a company's domestic currency for inclusion in its accounts. For example, imagine you hold an asset worth $1.2 million. At the start of the year, when the exchange rate was $3 to the pound, the asset value in the UK accounts was £400,000, 1.2 million divided by 3. At the end of the year, when the asset value was $4 to the pound, the asset value appears to have fallen to £300,000, 1.2 divided by 4, a loss of £100,000. Economic risk is the risk that the currency in a country where we operate will weaken, thereby reducing the equivalent performance expressed in domestic currency terms. For example, imagine a business makes a profit of $15 million each year in 2 consecutive years. The average exchange rate was $1.5 to the pound in year 1 and $2 to the pound in year 2, producing a profit expressed in pounds of £10 million in year 1, whilst only £7.5 million in year 2. Although in dollar terms the performance has been maintained, expressed in pounds the performance appears lower in year 2 than in year 1. Transaction risk is the risk that the value of a transaction denominated in a foreign currency will change due to exchange rate movements between the contract being agreed and monies being transferred. For example, a UK company entered into a contract to sell goods for $900,000 when the exchange rate was $1.5 to the pound, i.e. the equivalent of £600,000. By the time the contract is completed and monies transferred, the exchange rate has moved to $2 to the pound. Accordingly, although the contract goes according to plan and generates sales of $900,000, in sterling terms, sales have fallen to £450,000. It is worth a reminder that whilst all of the examples above show a downside risk, i.e. a worsening of the position, companies could just as easily benefit from exchange rate movements. Managing translation risk. The easiest way to manage translation risk is to match foreign assets with foreign liabilities, i.e. use foreign currency finance to purchase the assets. The impact of this is that if the asset falls in value in domestic currency terms, the liability will also fall in value, thereby offsetting the loss in asset value. Managing economic risk. To avoid exposure to an economic risk, a company would want to avoid entering an economy where it was anticipated that the currency might weaken. Obviously, over an extended period of time, currency values will tend to ebb and flow, thereby making such an approach difficult. Notwithstanding this fact, in the short term, the following factors might all indicate that a weakening of the currency was likely. High inflation in country A relative to country B would indicate that the currency of country A would weaken relative to B. This phenomenon can be used to estimate future rates, and the exchange rate in 1 year's time can be calculated as the spot rate multiplied by 1 plus the inflation rate in the foreign currency and divided by 1 plus the inflation rate in the home country. This is referred to as purchasing power parity. For example, if the spot rate is $2 to the pound, US inflation is 5% and UK inflation is 3%, the expected rate in 1 year is 2 multiplied by 1.05 divided by 1.03, which equals approximately 2.04. As discussed in the circular flow of income presentation, high inflation rates often lead to high interest rates, and the latter is another indicator that a currency may weaken. Further, interest rate parity theory can be used to calculate forward rates covered later, in the same way that purchasing power parity is used to predict future exchange rates. The difference between the two is that whilst the latter uses inflation rates, the former uses interest rates. Finally, a balance of payments deficit, the situation where imports are higher than exports, or high government borrowing, are both indicators that a country is not doing well and could result in its currency weakening. Managing transaction risk. There are broadly two categories of risk management, and these can be thought of as internal, i.e. the company can achieve on their own, and external, i.e. the company will use derivatives and other financial products. Internal approaches for an exporter receiving foreign currency include trading in your domestic currency. This does not remove the risk, however, it does transfer it to your customer. The ability or otherwise to achieve this is dependent upon the relative bargaining power of the two parties. Leading. This refers to encouraging your customer to pay more quickly so that funds can be received and exchanged before rates change too much. Lagging. This involves delaying the exchange of monies received in the hope that the exchange rate will move in your favour. Netting and matching involves creating payments in foreign currencies so that monies received do not need to be exchanged. External approaches include forward contracts, money market hedges, and futures and options, and these are discussed in more detail below. Forward contracts are an agreement to buy or sell a fixed amount of currency on an agreed date at a rate that is agreed now. They work in exactly the same way as an exchange at spot. However, there is usually a larger spread between the buy and sell rates quoted. They are easy and quick to arrange, are available in many currencies, and available for more than a year ahead. Conversely, they are non-cancelable, have to be honoured on a specific date, and the rates quoted may be unattractive. A money market hedge involves buying or selling the currency relating to the transaction now at spot, so that the exchange rate achieved is known. More specifically, for a currency receipt, the process is as follows. Borrow an amount of foreign currency today equal to the amount due to be received less the interest that will accrue on the borrowing. Use the currency borrowed to buy domestic currency at spot and deposit the domestic currency acquired for the period up to the date for the receipt of the transaction currency. This will earn interest to offset part of the cost of the currency borrowing. The net receipt under both approaches should be very similar. A future is a derivative product that is separate from the business transaction giving rise to the risk. If a business is expecting to receive an amount of foreign currency in the future, this will be converted at the prevailing rate at that time. The risk is that they will not know what the exchange rate will be, and therefore the domestic equivalent of the currency. The company will be concerned that if the foreign currency weakens, the effective receipt in its domestic currency will fall. To offset this, the company will enter into a separate futures contract to buy domestic currency in the future. This contract is set up in such a way that the company will benefit if the foreign currency weakens. The net effect is that a loss on the transaction is offset by a gain on the future and vice versa. The company will need to deposit funds when they buy the future to cover any losses that may arise. Options are very similar to futures. However, the company has an option whether or not to exercise the contract. This means that they will use gains on the option to offset losses on the transaction, but will ignore the option if the transaction shows a gain. This approach allows the company to avoid the downside while still benefiting from any upside. However, a premium is paid to obtain an option, and this may make it an expensive option. Thank you.
Hello. In this video, we'll be considering how organisations can manage their foreign exchange risk. Steps taken to reduce or eliminate a company's exposure to foreign currency risk is known as hedging. Initially, let's be clear how an exchange rate works. An exchange rate is simply the price of one currency in terms of another. A spot rate just means the rate of exchange right now. For example, a spot rate of exchange of $2 to £1 means that £1 sterling has an equivalent value of $2. This means I could exchange £1 for $2 or $2 for £1. Banks will do this for us for a charge. They make their money by offering us a different price for buying as opposed to selling. A shopkeeper does exactly the same thing. They might buy a tin of soup from their supplier for 75 cents and sell it to their customer for $1. They make 25 cents profit every time they then buy and sell a tin of soup. Banks offer what is known as a spread. This just means two prices, a buy and a sell price. For example, they may offer a spread of 1.3 euros to 1.25 euros per dollar. This means if they're buying dollars, they will only pay 1.25 euros, but they'll sell dollars to you for 1.3 euros. Often it's tricky to decide which is the right price to use. Remember this golden rule: always pick the worst rate for you. That's because it's the best rate for the bank, and the bank always wins. The worst rate for you means if you're selling currency, you'll get the smallest amount back, and if you're buying currency, it costs you the most. If I am an American and I export to Europe, and my European customer owes me 1 million euros, suppose the exchange rate when they pay me is 1.25 to 1.3 euros per dollar. When my European customer pays me, I will need to divide by either 1.25 or 1.3 to work out how many dollars the bank will give me when I sell them the euros. If I divide by 1.25, this would give me 1 million divided by 1.25 equals $800,000. If I divide by 1.30, this gives me 1 million divided by 1.3 equals $769,231. This is smaller than $800,000, so the 1.3 is the worst rate for me, and this is the one that the bank will give me. If we made our sale on credit, the spot rate of exchange will probably move between the point of sale and when the customer pays. So unfortunately, we cannot guarantee what the dollar value of that receipt will be. Now, let's consider ways of trying to remove our exposure to that fluctuating spot rate. There are some simple ideas, sometimes known as internal hedging techniques, so called because external contracts are not used. Firstly, as an American exporter, we could invoice customers in US dollars. We therefore won't be exposed to any foreign exchange. Unfortunately, all you're doing here is passing the risk 100% onto our customer. Our European customer will have to pay a certain number of dollars when they settle their bill. As the spot rate moves, the amount of euros this will cost them will fluctuate. The customer may choose to buy from elsewhere if we impose this risk upon them. Secondly, netting and matching. If we export to Europe from America and also import from Europe, then we only need to worry about the net position, as we are matching incomes with expenses here. If the exchange rate moves against us on the receipt, it will move in our favour on the payment, and vice versa. Netting can be considered at a group level. One subsidiary could export to Europe and another subsidiary could import from Europe, and even though they are each individually exposed, only the net group position needs to be considered. This overall view can be compiled by a group treasury function. This is convenient if possible. However, having receipts and payments relating to the same foreign location may be unlikely. Next, let's consider leading and lagging. Leading means paying early, and lagging means paying late. Suppose we're an American exporter who have a customer in Europe who's due to pay us in 2 months' time. If we also happen to have a European supplier that we're due to pay in 3 months' time, we may choose to lead and pay the supplier in 2 months' time to match the timing of the receipts from our customer. This means the movement in the spot rate between the point of sale and the point of payment will be the same, as we are ensuring we pay our supplier at the same time as we receive money from our customer. However, paying suppliers early is bad news for our cash flow, and paying them late is bad news for our supplier relationship. Let's now consider some external hedging techniques. These involve contracting with third parties to help manage our risk. We'll consider forward exchange contracts, money market hedges, and the use of derivatives such as futures and options. A forward contract is a contract agreed with the bank to exchange a certain amount of foreign currency for a specified rate on a specified date. These are common in practice because they are easy to arrange. It's a conversation with the bank, and it gives certainty. From the moment the contract is signed, you know exactly what the exchange rate is going to be relating to that future transaction. The banks will quote a price when you go to see them to arrange the contract. This might look like a spot rate, for example 1.25 to 1.35 euros per dollar. Forward rates also have a spread like spot rates do. Only the difference between the two prices is larger than the spot rate, as the bank extracts more compensation for the administration of the contract and the risk they take on. The spot rate may be different from the forward rate when the contract is executed. Alternatively, the forward rate may be quoted as an adjustment to the spot. For example, Today's spot rate may be 1.25 to 1.35 euros per dollar, with a forward adjustment of 0.3 to 0.2 cents premium. Firstly, a premium needs to be deducted from the spot rate and a discount needs to be added on. You might like to remember this using addis, add a discount. This might feel counterintuitive, but the reason we deduct a premium is that as the currency is at a premium, you get less of them to the dollar. So the forward rates implied by this forward adjustment would be calculated as follows. So we've got spot rates of 1.25 and 1.35 euros per dollar. We then deduct the forward premium of $0.003 and $0.002 to give us forward rates of 1.2470 and 1.3480 euros per dollar. And again, pick the worst rate for you. If I'm selling euros, I'll divide by 1.3480 to work out how many dollars I'll receive. And if I'm buying euros, I'll divide by 1.2470 to work out how many dollars I'll need to pay. Forward contracts fix the rate for us, but they are a binding obligation and therefore unavoidable if, for example, our customer defaults. And they're tailored to us. We are a named party in the contract, as is the bank. They therefore offer no flexibility and the contract can't be sold on. Another external hedging technique is a money market hedge, sometimes known as a synthetic forward. The reason we're exposed to spot rate movements is that cash is going to cross borders at some point in the future as opposed to today. We can eliminate risk by borrowing the money now and crossing borders today instead. This is perhaps easiest to see by talking through an example. I am a US exporter and I've made a sale to my European customer. They are due to pay me in 3 months' time. Suppose the current spot rate is 1.25 to 1.35 euros per dollar and interest rates in the two locations are as follows. We have US and European borrowing rates at 4% and 5% and lending rates or deposit rates at 2% and 3% per annum. These rates are generally quoted on a per annum basis in questions. Now let's suppose the value of the sale is 1 million euros. Let's work through a standard diagram to help us. On this diagram we have the US and Europe across the top and then a timeline down the side, now and in 3 months' time. Starting with the end in mind, we'll receive 1 million euros in 3 months' time. We would love to bring that money across border today, but we haven't got it. That's okay, we can borrow the euros to bring it back. Unfortunately, the amount we borrow will have to be less than 1 million euros because the amount we borrow will accrue interest charges over the 3-month period. The European borrowing rate is 5% per year, or 5% divided by 4 equals 1.25% for the 3 months. So we'll discount the 1 million euros by 1.25%. So this means we need to borrow 1 million euros divided by 1.0125 is 987,654 euros. This will then grow into a 1 million euro liability that we can pay off with the 1 million euro receipt from our customer in 3 months' time. We then bring back the money we've borrowed to the USA at today's spot rate. The worst rate for us is to divide by 1.35 to give us the smallest number of US dollars in our hands. This gives us $731,596 today in the USA. To get a comparable dollar amount for our receipt in 3 months' time, we assume that the US dollars are put on deposit in the US. This will earn us 2% per annum or 0.5% for the 3-month period. We therefore end up with 735,000 $254 in 3 months' time. This means we have achieved for ourselves an effective exchange rate of €1 million divided by $735,254 or 1.3601 euros to the dollar. A similar approach can be used to hedge payments to an overseas supplier rather than a receipt from an overseas customer. The only difference is that the money would be borrowed in the US and sent over to Europe to put on deposit there. This deposit would then be used to pay the European supplier in 3 months' time. Money market hedges are often used by banks and in many ways achieve a similar result to a forward contract, perhaps with a bit more flexibility. However, they require management effort to set up overseas deposits and loans, which may not be easy in all cases. Derivatives can be used to help reduce or eliminate foreign currency risk. We'll consider futures and options here. You should note that numbers are not examinable, only an overview is required. Firstly, futures. Suppose we know we have a foreign currency receipt in the future. We can effectively agree right now a rate with the futures market. We need to pay a deposit to an exchange in order for this to happen. When we receive the money from our customer, we would exchange that at the prevailing spot rate. However, the futures market will compensate us if we make a loss due to adverse movement in the spot rate. Similarly, if the spot rate moves in our favour, the futures market will take that gain away from us. In effect, the futures market acts like a counterbalance on a seesaw. The net effect is a fixed outcome, as gains and losses due to movements in the spot rate are effectively removed by the futures market. Futures give some date flexibility. For example, September futures can be used at any time up to the end of September. So if the customer pays a little late, this can usually be accommodated. However, futures are only available in large standard contract sizes, and a deposit needs to be made and potentially topped up if the futures contract is building up losses in the run-up to the customer paying their bill. Futures can be used equally to hedge payments as well as receipts. Next, options. An option gives the buyer a right, but not an obligation, to buy or sell something at an agreed price. An option to sell is called a put option, and an option to buy is called a call option. So, for example, an option to sell euros would be known as a euro put option. If the price agreed in the option, known as the strike price or exercise price, is better than the spot rate when the customer pays, then the option will be exercised and the holder of that option will receive the agreed exchange rate in the option, the strike price. If, however, the spot rate is more favourable than the strike price in the option, then the option can be abandoned and ignored. The holder of the option can then use the more beneficial spot rate. There is a price to pay for this flexibility. An option only seems to have upside potential for the holder and no downside. The seller of the option charges a premium at the start that's non-refundable, a bit like selling an insurance policy. An option, if it's exchange traded, gives date flexibility like a futures contract does, and it has upside potential with no downside risk. It's also useful for transactions if they aren't definite. For example, if we tender for a contract, we could hedge the offered tender price using an option that we could then just abandon if we fail to win the tender. However, exchange-traded options, like futures, are only available in large standard size contracts, and the option premium makes them very expensive. Last but not least, something a little different. Suppose we invest in a foreign subsidiary. This means we'll have a foreign currency asset on our statement of financial position. As foreign exchange rates move, then the value of this asset will increase or decrease due to movement in that spot rate. If we finance this investment with a loan also denominated in that foreign currency, this will cushion our exposure. As the value of the asset increases, so will the value of the liability, and similar for a decrease. In summary, there are many ways of reducing or eliminating foreign currency risk, and each has its own advantages and disadvantages. The treasury function of the business will need to decide what's most appropriate in the circumstances.
Hello. In this presentation, I'm going to look at interest rate risk, both in terms of what it is and how companies might protect themselves from its effects. It is also worth noting that there are many crossovers between the risk management techniques described here and those discussed in the exchange rate risk presentation. Accordingly, it may be beneficial to watch that presentation first if you have not already done so. Specifically, this presentation will cover types of interest rate risk, the yield curve and how it can help companies determine their approach, internal solutions, forward rate agreements, and futures and options. Let's look at each of these in turn. Types of interest rate risk. The interest rate determines the amount of interest paid on borrowings and the interest received on deposits, and can therefore have a significant effect on the performance of an organisation. This presentation will focus on loans being taken out, i.e. interest being paid. However, the same principles could equally be applied to deposits. The following risks need to be considered. 1. If an existing loan has a variable or floating rate of interest, this can lead to the amount of interest paid changing throughout the period of the loan. 2. If a company is planning to take out a loan in the future, even if this is at a fixed rate, the interest rate and therefore the profit impact can change between the decision and the loan starting. 3. Interest-bearing assets and liabilities may not move in line with each other. This is known as basis risk. And 4. Interest rates on assets and liabilities may change at different times. This is known as gap risk. The last two aspects are mainly relevant to banks and are not considered in detail here. However, we will now look at the first two in more detail. The yield curve and how it can help companies determine their approach. The term structure of interest rates looks at the yield on bonds and how this varies with the maturity of the bond. It is usually based on government bonds and enables companies to establish a view as to the likely movement in interest rates. As can be seen from the graph, a normal yield curve is upward sloping, indicating that loans get more expensive the longer they are. The precise shape of the curve is governed by three separate theories. 1. Liquidity preference theory states that investors like to hold cash, and accordingly, the longer the period they are asked to give that up, the greater the compensation they require. This explains why the curve is upwards. 2. Market segmentation theory explains that loans of different maturity are obtained from different segments of the market with different expectations. This explains why the graph is a curve rather than a straight line. And 3, expectations theory reflects expectations as to future interest rates. This reflects the angle or slope of the line. For example, a steep sloping curve would indicate an expectation that rates will rise. Internal solutions. Companies will often adopt an approach known as smoothing in an attempt to manage the interest rate risk on current borrowing. This refers to holding an appropriate mix of fixed and variable rate debt. The fixed rate provides protection from adverse rate movements, whilst a variable rate still allows them to benefit if the rate moves in their favour. It is important to remember that risk simply refers to a variability in the possible outcomes. As such, there is an upside as well as a downside risk. In determining what an appropriate mix is, companies will take into account both expectations as to what future rates will be and the impact that rate movements will have. For example, if a company has relatively low levels of debt, they may be willing to use a bigger proportion of variable rate, as an increase may not prove too costly. A company wishing to change the proportions may consider entering into a swap arrangement, an agreement whereby two companies pay each other's interest rate liabilities. This aspect is not covered further in this presentation. Forward rate agreements. A forward rate agreement, or FRA, enables a company to fix the interest rate it will pay or receive on loans it is planning to take out in the future. It is very similar in terms of what it achieves to the forward contract described in the exchange rate risk presentation. However, the mechanics as to how it achieves the outcome is very different. The major difference is that the FRA is a separate contract from the loan itself, i.e. the FRA is not a loan. An FRA fixes the rate of the loan and is shown as follows. So £10 million, 4 to 7 FRA at 6%. In this example, the interest rate on a 3-month £10 million loan, starting in 4 months' time and finishing in 7 months' time, at 6%. If in 4 months' time the rate applicable on the actual loan is higher than 6%, the company will receive compensation from the FRA equal to the actual rate minus 6%. Conversely, if the actual rate is less than 6%, the company will pay compensation. Either way, the effect is that the combination of the interest rate on the loan and the compensation paid or received on the FRA fixes the rate at 6%. Finally, it should be noted that the FRA rate refers to the base rate or LIBOR. Companies will borrow at a premium above LIBOR based on their credit rating. For instance, in the above example, a company who can borrow at LIBOR plus 1% will fix the rate at 7%, being the 6% quoted in the FRA plus the 1% premium. Futures and options. Futures and options are derivative products and they work in a very similar way to that described in the exchange rate risk presentation. A future is exchange traded, which means it is only available in set contract sizes, for example blocks of £500,000, and so it may not be possible to exactly hedge the loan being taken out. A future is similar to an FRA in that it is separate from the loan it is protecting, and the process is as follows. A company plans to take out a loan in the future and will take out that loan at the prevailing rate at that time. Separately, the company will sell interest rate futures, i.e. a commitment to pay interest in the future. When the loan starts, the company will close out the futures by buying contracts, i.e. a commitment to receive interest, simply the opposite of the original futures position. If interest rates have increased between the decision to take out the loan and the loan starting, the loan will have become more expensive than anticipated. However, if the rate has increased, the company will be receiving more interest on the futures bought than it is paying on the futures sold. This gain on the futures offsets the loss on the loan. If interest rates decrease, the opposite happens, and the loss on the futures offsets the gain on the loan. Either way, the effective rate when the two aspects are combined is fixed. A company taking out futures will be required to deposit funds, called paying a margin, to cover any losses that may occur on the futures. The margin will also need to be topped up if losses increase, but is returned to the extent that it is not needed. An option works in exactly the same way, but with one important distinction. Under an option, the holder can decide whether or not to exercise the option. This means that if the loan cost has increased, the company will exercise the option, thereby benefiting from the gain and reducing the effective loan cost. Conversely, if the loan interest has decreased, the loss on the option will be ignored. Accordingly, an option enables the company to cap the rate of interest payable at a maximum while still being able to benefit if the rate goes down. Whilst this is obviously very attractive, options have to be purchased, i.e. a premium is paid, and this can make them expensive. Thank you.
Hello. In this video, we will consider some of the techniques available for managing interest rate risk, including matching and smoothing, asset and liability management, forward rate agreements, also known as FRAs, and derivatives. Derivatives, the use of futures and options to help manage interest rate risk, is a discursive topic only. No numbers will be set on this in the exam. Firstly, let's consider matching. Suppose I'm a bank and a customer has come to see me to ask about a mortgage on a property. If that customer would like a variable rate mortgage, in other words, the interest rate will go up and down in line with market rates, the bank's income will vary depending on what the prevailing rate is. It might be sensible for the bank to finance this mortgage by taking out a variable rate loan itself. If the bank were to do this, then as interest rates rise in the market, then as income from our customer rises because we charge them more, our own finance charges will rise similarly. This means the bank's profit, the difference between income and expenses, will stay approximately the same. For example, suppose the bank agrees the mortgage with their customer and the variable rate of interest at that point is 5% per annum, and the bank manages to finance that mortgage by obtaining a loan from elsewhere at a variable rate of 3% per annum. The initial profit of the bank will be 5 less 3 is 2%. If, let's say, interest rates on the market rose by 1%, then this would mean the income from the customer would increase from 5 to 6%, and the interest we have to pay to finance that customer would increase from 3 to 4%. The bank's income is still 6 minus 4, or 2%. This protects the bank's exposure to increases and decreases in interest rates. If the customer had originally asked for a fixed rate mortgage, the bank could then finance this with a fixed rate loan, so that the bank's income and outgoings would stay the same no matter what happens to interest rates. In other words, the bank is matching variable rate assets with variable rate liabilities and matching fixed rate assets with fixed rate liabilities. Next, let's consider smoothing. If a company uses nothing but variable rate loans, then the interest that it pays will rise and fall in line with what happens with variable rate interest rates. This makes interest rate costs relatively volatile. An alternative would be to use all fixed rate loans, which eliminates the volatility, but there's no benefit to the company from a drop in market rates. The company may decide to use a mixture of both fixed and variable rate loans. Suppose it uses 50% fixed and 50% variable. Interest payments still vary with changes to the variable rate, but it's smoothed by having a proportion of the debt as fixed rate. The company can decide what proportion it would like. The more heavily weighted it is towards fixed rate finance, the flatter this line will become. Assets and liability management considers the nature of projects and the cash flows associated with them, and seeks to match the nature of those cash flows with the nature of the finance. For example, if a project is likely to generate very stable cash flows, it makes sense to match this with stable outgoings. In other words, finance it with a fixed rate loan. Matching, smoothing, and asset and liability management are all examples of internal hedging techniques. In other words, external contracts are not used specifically to manage interest rate risk. A forward rate agreement, or FRA, is an example of an external hedging technique. An FRA is separate from the loan, but acts as a top-up payment or receipt. Suppose it's the 1st of January, and as a result of doing our cash flow forecasting, we see we need a $5 million 6-month loan in 3 months' time. Even if we were to fix the rate on that loan when we sign it in 3 months' time, we couldn't say now, on the 1st of January, what rate we'll get when we fix it. This is where we can use an FRA to help us. The bank offers us a $5 million 3 to 9 FRA at 5%. The 3 to 9 refers to the number of months until the loan starts from today and the number of months from today until the loan finishes. So a 3 to 9 FRA describes a 6-month loan due to start in 3 months' time. This FRA is guaranteeing a base rate of 5% for the loan. When we sign the loan in 3 months' time, suppose the base rate is 5.75%. When we sign the loan, we'll pay the base rate of 5.75% on the loan itself, but the FRA will pay us 0.75%. So overall we pay a net of 5%, which was the base rate we agreed to in the FRA. The quid pro quo for this, though, is that if, suppose for example, the base rate drops to 4% by the time we sign the loan agreement at the end of March, we'll pay a base rate of 4% on the loan itself, but we'll have to pay an extra 1% under the FRA. Again, this equates to a total payment of 4 plus 1 is 5%. In other words, in coordination with the actual loan we take out, the FRA is guaranteeing us an overall base rate of 5%. FRAs guarantee us a rate, but they're a binding obligation. If rates drop in the intervening period before we sign the loan, we're forced to pay under the FRA. Equally, if circumstances change and we actually don't need the loan, the FRA remains in place and will be obliged to pay if rates drop, albeit we'll have a receipt if they rise. It's worth noting that a saver or lender can also use an FRA that will pay them compensation if rates drop, and they'll have to pay out under an FRA if rates rise. In other words, the net rate is protected. A saver is described as selling an FRA, whereas a borrower is described as buying an FRA. Futures contracts can also be used to act as a counterbalance against movements in interest rates. They work on a similar principle to that explained in relation to foreign currency risk management. Following from our earlier example, a rate is agreed with the futures market when it's forecasted that we'll need to borrow in the future. So, if on the 1st of January we realise we'll need to borrow $5 million on the 1st of April, we can agree a rate for the loan that we'll sign on the 1st of April on the 1st of January with the futures market. At that point, on the 1st of January, we'll need to pay a deposit to the exchange. If by the time we get to the 1st of April rates have risen, the futures market will compensate us for the increase in rate. If the rate drops, we'll need to make up the difference and make a payment to the futures market. In many ways, the outcome appears to be similar to that of an FRA. However, FRAs relate to a particular date when the loan will be signed. You get some date flexibility with futures. For example, a March future can be used on any day up to the end of March. However, futures are standardised contracts and relate to a fixed amount of borrowing for a fixed period of time. For example, one futures contract might relate to a $500,000 loan for 3 months. If we wanted to borrow $1 million for 6 months, we'd need 4 futures to cover the amount of interest. We would need to double up for the amount and double for the term. Due to standard contract sizes, you may not be able to get an exact match for your needs. You may end up being over or under hedged. In addition, the deposit you need to pay up front may need to be topped up if it looks like losses are accruing in relation to your futures. The exchange will not take credit risk. In other words, if you run up losses, you need to pay them as you go. This presents a liquidity disadvantage, therefore. Cash outflows even before you sign the loan. Options operate very much like futures, except there's no downside other than a premium that needs to be paid at the start. As a result of paying the premium, if rates in general drop in the run-up to you taking out a loan, you get to keep the low loan rate and you won't have to pay out under the option. In similar circumstances, if you'd used a futures hedge, the low rate would effectively be taken away as you have to pay out losses under the futures arrangement. However, if rates rise, you pay out more for the loan you sign, but you receive compensation from the options market. This means you can benefit from a drop in rates if you're a borrower, but are protected from an increase in rates. However, the price you pay is a premium as the hedge is set up. A short note on terminology. A borrower would hedge potential borrowings using a put option or selling futures. A saver or lender can also use derivatives to hedge against interest rate movements. They'll be concerned about a fall in rates, as this will reduce their income. They will hedge this position by buying futures or using a call option. In summary, internal hedging techniques can be used to mitigate interest rate risk, such as matching, smoothing, and asset and liability management. External techniques can also be used, forward rate agreements and futures and options. Remember, in your exam, futures and options are not examinable numerically. In this video, we consider the nature and type of risk that exists in organisations and approaches to risk management. This is a very broad topic and is almost a subject in its own right. We'll therefore restrict our discussion here to what is examinable in the F9 paper. First of all, let's distinguish between risk and uncertainty. Risk concerns known possibilities or outcomes and known or estimable probabilities. The benefit is that we can therefore do some calculations to help us assess the risk. For example, the risk associated with tossing a coin. There are 2 possible outcomes, heads or tails, and a 50-50 chance of each. With uncertainty, either some of the probabilities are not known or potentially some of the possible outcomes are not known, or maybe a mixture of the two. When starting out on a new venture, you may have no real idea how likely it is to be successful. This is uncertainty. Although this distinction may be important for a multiple choice question in your exam, the terms risk and uncertainty are often used interchangeably in everyday language. Strictly speaking, risk can be upside or downside. Upside risk is the chance that something good might happen, as opposed to downside risk, which is the chance that something bad might happen. That said, the word risk often has a negative connotation associated with it, so it's often taken to mean the negative or downside. It's worth noting that risk management is not the same as risk minimization. At some point, a company's investors decided to invest in the company, which implies taking a risk with the hope of making a return. Inherently then, business cannot be about simply minimizing risk. This would imply never setting up in business in the first place. That said, risk must be managed to make sure that risk that is purely downside is eliminated where possible, and the remaining risk is managed to a level that's acceptable to investors. Different decision makers may have a different attitude to risk. A risk-averse decision maker focuses on the downside and makes the decision that ensures the downside is the best it can possibly be. It's an inherently pessimistic outlook, as the risk-averse decision maker is assuming downside will occur. A risk-seeking decision maker will consider potential upside and choose options where that upside is high. This is an inherently optimistic view, as it doesn't consider the downside risk may result. The risk-neutral decision maker will make their decision based on the balance of probabilities, without focusing particularly on positive or negative outcomes. Risk comes in various different guises, and many frameworks are available to distinguish between different types of risk that the company may face. Simpler frameworks may consider, for example, strategic, financial and operational risk. Other frameworks can become much more complex. There are also frameworks to assist an organisation with managing the risks that they identify. However, this is a topic that is examinable elsewhere. There are two particular aspects of risk and risk management that our examiner focuses on: foreign currency risk and interest rate risk. In the remainder of this video, we'll examine the nature of this risk. We'll consider how managing this risk can be undertaken in other videos. First of all, foreign currency risk. Foreign currency risk includes the way we are financially affected as a result of movements in exchange rates. An exchange rate is simply the price of one currency in terms of another. So, for example, an exchange rate may move from $1 to £1 to $1.30 to £1. This would mean that anyone who exports from the USA to the UK used to get $1 for every pound of export revenue, whereas they are now getting $1.30 for every pound of export revenue. Foreign currency risk can be one of three types: translation risk, transaction risk, and economic risk. Suppose we are based in the USA and we sell something to someone in the UK. If we give our UK customer 3 months credit and we're invoicing them in sterling, we don't know how many dollars that sterling is going to be worth when they pay in 3 months' time. That's because the exchange rate will move between now and then in a way that we can't predict with any certainty. This is known as transaction risk. It directly affects the cash flows of the business. We will end up with more or less dollars as a result of transaction risk. Now, suppose we have a financial reporting deadline, such as the year end, 1 month after we make the initial sale. At the year end, we will have a foreign currency receivable on our statement of financial position, being the amount that our UK customer owes us at that point. This receivable would need to be retranslated at the exchange rate prevailing at year end, and any movement between the point of sale and the year end in that exchange rate will therefore result in a profit or loss due to foreign exchange. This is known as translation risk and will affect reported profits. Although exchange rates fluctuate constantly, they often follow a long-term trend that's consistent with the changing economic circumstances of the two countries in question. These long-term trends can fundamentally affect the value of our business. For example, if we constantly make sales to the UK from America, then the value of each individual sale will go up or go down in value depending on the direction of the exchange rate movement at the time. However, over time, there may be a long-term trend, which means fundamentally the value of my business gradually increases or decreases because of that direction of movement. This is known as economic risk. We may face economic risk even if we don't sell overseas, as it may affect our input costs or our competitors' pricing. Interest rate risk is an increase or decrease in our profitability due to movements in interest rates. A simple example of this is a company with a variable rate loan. If that variable rate increases, interest payments will increase. If the variable rate falls, then interest costs will fall. Gap exposure occurs if the company has a different amount of interest-bearing assets and liabilities. The net exposure will generate an impact on profit when interest rates move. Basis risk occurs when interest-bearing assets and liabilities vary with reference to a different interest rate source. For example, interest rates on savings that are based on LIBOR, the London Interbank Offered Rate, may move at different times or by different amounts to liabilities that may be based on, say, Euribor, the European equivalent of LIBOR. Again, this means that company profits will be exposed as the interest rates move at different times or by different amounts. In summary, risk is essential in business, but it needs to be managed to maximise returns for a controlled level of risk. Risk management is a large subject area. However, our examiner only touches on a relatively small part of risk management, essentially interest rate risk and foreign currency risk.